Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, my name's Mitchell Sneddon, and in today's episode of the Australian Investors Podcast, I'm joined by Intelligent Investors Senior Analyst Gaurav Sodhi. This is Gaurav's second time on the podcast, and it acts as a deep dive on the topics covered in his first visit. We jump right into a failed investment and the public outcry that followed. We talk investing in funds management businesses, backing oddball CEOs, investing in resource companies, the good and the bad of management and board incentives, and we even create a new ETF. It's a wide-ranging chat, and I highly recommend making it a double feature by going back and listening to his first appearance as well. Gaurav, I want to start this podcast out by reading a comment or a quote to you. Now it goes, "I'm very disappointed with the bailout when the going gets rough. I followed your advice and bought when you said and then held. Now you bail out, and I now question the quality and depth of your research. How easy it is for you." Now, this is just one of 116 comments on an article when you put a sell call on Magellan Financial Group. That was approximately 2 years ago now. So in your last podcast that you did with Owen, you talked about failure and how you wanted to instill in your son a sense that it was okay to fail. Can we go back to this time? And I'm sure you probably remember it fairly well. It was a pretty hairy time in those comment sections on the Intelligent Investor website. Can you talk us through how you were feeling when you were seeing these comments mount up and up and up on this particular article after you knew they were probably going to be coming down the pipe at you when you put this sell decision on Magellan Financial Group? Can you tell us about how you felt then? And also tell us actually about the decision to buy and then sell Magellan Financial Group as a whole for people who are unfamiliar with that situation.
Sure. Geez, there's no soft questions to start off with, right?
This isn't a first date, Gaurav. We've known each other for a while.
Well, that's what I was going to say. This could be because we've known each other for a while. But okay, let's dive right into the hard stuff. I think maybe let's start with Magellan and why I slapped a buy on Magellan in the first place. Because this was a stock that went from being a little net cash box. It was about $1 at one stage, and it rose all the way. What did it get to, Mitch? Like $70 or something?
I think close to 80.
There you go. It rose a long, long way. And we only really got interested around the $40 mark. And at that stage, what piqued my interest was I thought at the time that this was not just a fund manager being built, and it wasn't just about fund flows increasing. What attracted me to the business was it looked as though there was a new diversified financial conglomerate being established.
People were calling it a mini Macquarie, so to speak.
I wouldn't call it that myself, but I think I take your point. It's not just a fund manager. They had an infrastructure stream. They had a private equity stream. They had an income generation stream. And there was also talk of doing a retail-based product. There was a whole different bunch of products being launched using the brand, the distribution, and the staff. And a lot of it was under the aegis of the individual himself, Hamish Douglass. But it was also larger than Hamish Douglass, I thought at the time. And so what we were buying into then was the start of the establishment of a large diversified financial institution. The first time really that's happened since Macquarie started growing and building competition to the big four banks. And I thought that was quite a good shot that Magellan would work as a diversified financial business and not just as a fund manager. Now, as we know, that's not how things turned out. Hamish Douglass himself had a lot of personal issues. His brand suffered. Funds started flowing out of that business. They lost a lot of staff. and the strategy completely changed. So as soon as the fund flow started falling and Hamish himself left that business, the strategy stopped being to try and develop these different income streams and these different products. And they went back to try and reestablish and retake some of the fund that had been flowing out. So there was a change of personnel and a change of strategy. The investment case, in my mind, was completely broken. And there's a rule I tend to follow, that when you have a broken investment case, the first thing you should do is sell. And so
that's what you did.
And that's what I did. I put a sell on it. And to me, it was very logical and very sensible. Things have changed. Do you stick with the same line of thinking you had when things were different, or do you change your mind as well to reflect the new reality? I was pretty comfortable with that. You suggest I sort of had some foresight about the controversy that would follow, and I honestly didn't. I thought it was a perfectly logical and sensible decision to change my mind, and I was quite stunned by the reaction. And I guess I wasn't. I'm not a highly emotive person, Mitch. I wasn't hurt. I wasn't angry. I was confused. I just looked at a lot of people who I thought were acting completely irrationally, and I didn't understand that response. I thought my response was quite rational, and I didn't understand why people were getting so upset. And the other thing I'd say is I think that's also because I've been investing for 20 years, probably more than 20 years, and I've lost a lot of money on individual investments in that time. And it doesn't bother me. I mean, I lost a six-figure sum on Magellan myself. Didn't lose a night's sleep over it. Didn't blink. It didn't. I mean, it was just a loss. I mean, there are gains and there are losses. I don't get too excited when, the coal stocks were life-changing for me. I wasn't euphoric then, and I wasn't depressed because I'd lost money on Magellan. I just think you've got to try and if you're going to be good at this, you've got to maintain a steadfastness about your emotions, and you can't get carried away and you can't get despondent. I think that comes naturally to me, and I'm just surprised sometimes when I don't see the same thing in other people.
I was going to say that comes naturally to you. For those who it doesn't maybe come naturally to, yes. Is there any little tips or tricks you can think of to help people?
I sometimes think this is one of the superpowers that certainly of my style of investing. Well, there are lots of different ways to invest. There's no single path to investing nirvana. But if you're going to be a contrarian investor, if you're going to tackle ideas that are unpopular, or even ideas that might be far-sighted, or I like to think original, some of the time you're going to be wrong, and how you react when you're wrong is really important. How you react when you're right is really important. This is a pursuit for the intellect. It's not a pursuit for the emotional. And so you've got to find a path, an investing path that suits your frame of mind. If you are an emotional person, there's nothing wrong with that. I'm sure you have a wonderful life, and investing is probably a small part of it. But you've got to find an investing path that's consistent with the person you are. I don't think one should change yourself to match your investing. I wouldn't counsel anyone to stop being, it probably is actually, to be honest, it probably is helpful to stop being so emotional when you're investing, but I don't think you should change your personality or change your life to alter your investment decisions. You should match your investment decisions with your personality and your psychology. And I think that starts with kind of knowing yourself a little bit. I think that's the first error a lot of investors make, is they jump into investing and they read about other investors. They read the Buffett way or some other way, and they try and copy that without understanding the person they are and trying to find something that's consistent with them. Now, I've done that. It's taken me more than 10 years to find a path that's consistent with who I am, and it's probably not for everyone, but I think that journey is really important, and that's what I'd encourage others to do. So in hindsight, at the time, I was confused by the backlash. I just thought, okay, we've lost money. I lost probably more money than most of my investors. There'll be other ideas, and sure enough, I mean, that was just before the coal train came along, and there's been a whole string of winners before and after that. There's been a couple of losers as well. This is the way. I mean, this is the path we take.
I want to just stick with the funds management companies for the moment. Did that change how you looked at funds management businesses as an investment option? Because I know you do invest in other fund managers still.
Yes, it did though, Mitch. You're right. And, it's okay to lose money, but really you don't want to lose money the same way twice. And, I don't have the large process where after I've lost money, I sit down and stringently go through with where I made the error. In some cases where there's an analytical error, I do that. I mean, I remember my two huge mistakes for me, and they happened back to back, so it felt particularly hard at the time, were PMP and Amasim. And I spent months going through those decisions, and they've been really informative. Those mistakes have been very informative in I think, improving my investment style. And I went through them in a lot of detail and trying to find out where I went wrong and where I could do better. I didn't really have that process with Magellan because I thought the investment case up front, it just didn't work out. And sometimes, you ever read I think it's from The Grapes of Wrath by...
I've not read that one, no.
By Steinbeck. Yeah. There's a character in there who says, there are 1,000 different lives to lead out there, but we only get a shot at leading one of them. And I really like that. There's in every decision we make, in every idea we have, there are 1,000 different potential outcomes, and only one of them is going to happen. Now, that just means you're going to be wrong a lot of the time. And so you've got to be okay with that. So look, I didn't go through and try and study the error, but there was something I picked up, and that was the importance of the individual in these fund management businesses is definitely something I underestimated. Hamish was so vital to their investment case, and when I saw instability and odd behavior from Hamish himself, that should have reflected more on Magellan, and I didn't create that link as strongly as I should have. So it has concerned me. So when I think that's what kept me out of things like GQG, which it also has been a mistake not to buy that. But it's a very prominent individual, and without that individual, I'm not sure that entire business works. It kept me out of Platinum, which actually worked out really well. Again, a prominent individual, and when he left, I wasn't sure that brand would hold up. And so, look, I have bought. I am a shareholder in Australian Ethical, and I own that because I couldn't tell you who the fund manager is, and I don't think anyone knows who the fund managers are.
I've got no idea. I've got no idea who's there. As well, I believe, so you own Australian Ethical personally?
Yes, correct, yes.
Okay. Can you just talk us what the attraction to that particular funds management business?
Look, I'm not an ethical investor.
We covered that on the very first podcast with Owen. You really did a deep dive into coal and how you had absolutely no gripe about holding that and making very good money from that investment decision. So, talk us through Australian Ethical.
Yeah, so what I found interesting about that was they've been doing ethical investing well before it became very popular and mainstream. And so they've established this brand that's associated with ethical investing. They've got a long track record that's actually quite powerful. And they're able to charge higher than average fees. Now, what's frustrating about this business is they consistently cut their fees, which is something I would counsel them not to do, but they always do it. And I suppose that helps reinforce the brand in many ways. But the fund has grown enormously. The best thing about AEF is that it's not so much a fund management business as it is a superannuation business. So it attracts a young cohort of people whose incomes are rising over time. And so their superannuation money just flows straight into the AEF product. And as their incomes rise, they actually get more dollars into that superannuation product.
It's got those natural tailwinds.
Incredibly sticky. So you can just forecast steady, reliable growth in FUM. And when I bought, I think they had about $4 or $5 billion in FUM. They now have closer to $10 billion of FUM. I'd like to see more scaling from AEF. It's not a perfect investment. I mean, it's done well, but there are changes. There are some things I'm looking for, but it's been a wonderful business. Owns the brand, a fantastic business product. And it's it's not led by an individual or focused around an individual. I'm quite happy with that one.
And I know in the Intelligent Investor Funds, Pinnacle as well has been, I wouldn't say cornerstone investment, but it's been in the funds for a long time.
Indeed. Yeah, I own that as well. I should add, I own Pinnacle as well. And I wouldn't really classify that as a funds management business. I view that really as a distribution business. And they've taken equity stakes in different fund managers, but their task is really to do back end and distribution for those fund managers. It's incredibly well run. The founder there, Ian Maloof, he's got a knack of picking the right fund, the right product, and he's assembling now a broad range of products they can take to financial advisors, and they can tick all their requirements from the single provider. He gets an equity-like upside, and the services he provides his funds are scalable, and the margins keep rising as the fund gets growing. So it's a very nice business, wonderful economics, really well led. It's a little pricey, I will say, but I think it's still fair for the amount of growth potential there is in that business.
So would it be fair to say you pay close attention when assessing a funds management business to the distribution arm, the distribution team? It is important, but look, it probably just depends on the business. Look, I'm going to sound like a junkie for fund managers by revealing a third fund manager I own, but this is micro equities, which I own a small bit of. The ticker code for that is MAM, I believe.
That's right, MAM. And look, this is a business that doesn't have a sophisticated distribution, different distribution shop. It doesn't have a whole bunch of analysts or a huge marketing team. It's a very small fund manager with sort of a single mandate, but it is led by a founder who owns a huge chunk of stock. Small focused board. They know exactly what they're doing. They pay most of their profits out as dividends, and they charge a lot of money. So performance fees are very juicy and at the right point of the cycle. I think we might be heading into the right point of the cycle. Speaking of cycles, let's jump across now to looking at investing in resource businesses. Now, I know at Intelligent Investor, the team are, tend to be generalists when it comes to the market. They don't generally have one specific niche that they go down. But if anyone has read your work in the past, and where a number of your success stories have come from has been in that resource side of things. So can you take me through how you go about actually finding an interesting resource business? What piques your interest when you first start looking in that area? Is it looking for commodities that are at the rock bottom in their prices? Where do you start? Yeah, for most companies, industrial businesses, we're trying to find great quality businesses led by entrepreneurial individuals. And price, for me, is less important in those instances. But the task is completely different when it comes to resources. These are cyclical businesses. So we're not going to hold these for a long time, for years and years to compound. These are businesses you want to hold at one point of the cycle and sell at another point of the cycle. So what I'm looking for is a really bombed out situation, a cheap share price, a commodity no one wants to touch, things that aren't hot or aren't interesting, and that's the place to start. All my resource investments have been bombed out situations where others don't want to touch them. I don't like buying hot stuff. When lithium was on the rise, we did not touch it. We actually came to lithium after the bubble had burst, and we missed all of that. And again, people were very upset with us because we didn't buy on the way up, and there was a vast silence when that thing collapsed, and we were completely unimpacted by it. So that it starts with that. I mean, my idea is that these aren't businesses I aim to own. There's a very high hurdle for me to make an investment in mining business, because I don't want to fill an allocation. The wrong way to do it is to think, right, I've got to have 12% of my portfolio in mining stocks. I've got to have 3% in gold. I need some exposure to copper. Goodness me, the data centers are taking off. I've got to find some copper exposure. I think that is madness. That is certainly not the way I would do things at all. I like to be patient with mining. You only want to buy these things when the opportunity is outstanding, because the risks, I assure you, are extraordinarily high.
Especially when you're looking for bombed out situations. The risks they're bombed out for a reason.
I don't know, Mitch. I reckon the risks are highest when prices are high, when an exuberance is high, because these are cyclical. Everyone feels wonderful at the top of the cycle. That's the most dangerous point. I mean, the last mining stock we recommended, I think, would have been Alumina. And geez, that was bombed out. I mean, that thing looked really, really ugly. It's bounced a lot. I must say that was hard to buy, because that was about as ugly a mining stock as you'll find.
Can you tell us why it was so ugly?
Well, not only was the Alumina, by the way, it's a holding company. It owns a minority stake in the world's largest bauxite and alumina producer. It's a joint venture with Alcoa. So not only was bauxite and alumina at historic lows, 30, 40% of the industry was loss-making. They had regulatory issues in their best assets in WA, and the government there was threatening to stop them accessing their best ore body, which would have raised costs enormously. They were swimming in debt, which meant that there was a risk of a capital raising, and that would have diluted the stock extraordinarily. So this was a very risky situation. But what piqued my interest was that this was bad. No one wanted to touch it. But this is probably the lowest cost miner in the world. It's got the largest, lowest cost assets in the world. It's a bunch of integrated mines, refinery, and logistics that have taken decades to assemble. It's irreplaceable. And if there's any time in the cycle to be buying excellent quality assets, it's when the price of those assets is on its knees, when uncertainty is at a maximum and no one else wants to look at it. So at those times, you've got to close your eyes and just buy. And sure enough, there was a takeover offer for the business, and it's I think it's bounced 80% or so from those lows, and I still think it's maybe half price.
One of my favorite lines that you've written recently, in my mind, for me, was your closing line on a mineral resources article recently, and it said, "I reckon yous should buy." and that was a play on the CEO of Mineral Resources at the AGM, constantly referring to everyone as yous, taking a leaf out of Jeff Fennick's playbook there.
Yeah, you're right. Together, but yeah, that's right.
And I recall back to your first interview with Owen, you'd said that investing, and this was a Kerr Nielsen quote, was a pursuit for the oddballs, and that really resonated with you. Would you put the CEO of Mineral Resources in, and this is a good segue, into that oddballs category? And who else would be your favorite oddballs as CEOs or investors in fund managers?
Yeah, absolutely. Chris Ellison deserves that oddball. I mean, his biography is remarkable. He was born in a poor little town, I think Dunedin in New Zealand. Grew up riding horses, and then was a rancher for some years. I mean, was a nomad for a couple of years. And when he started the business, started on his credit card with $10,000. And with no real aspirations other than to buy some equipment and then sort of lease it out. And from there, he's built this, this $10 billion empire straddling 4 commodity groups, and maybe the best mining services business in the country. I think it takes someone kind of weird and odd to do that. And you only have to listen to Chris Ellison to realize he's not your typical CEO. When you start listening to a lot of AGMs and presentations, you realize that there is a playbook for these things. The people who get promoted in big organizations, they're fulfilling a role, and a lot of their career is preparation for that role. And they learn that you have to dress a certain way, speak a certain way. There are things you can say and there are things you can't. And so when you come across people who break that mold, you really notice. Chris is definitely one of those people. He unapologetically, he'll swear. I reckon what will be interesting, Mitch, is if we put a statistical study together of CEOs who drop the F-bomb in public meetings. I reckon that you'd actually find that there's CEOs who swear in public meetings. I reckon they outperform CEOs who are just inoffensively polite all the time.
That is a fantastic idea for an ETF.
Yeah. The F-bomb ETF. You just call it the F-bomb.
Look, I'm not a CEO, but if I was, I'd be towards the top of that list.
So he unapologetically, he'll swear in his meetings. He knows that everyone in that audience, his investors, his bankers, and the fundies and the analysts, he knows they want him to speak correctly, but he's unapologetically himself. He'll say "use" in the meeting because that's the way the guy talks. He'll speak off the cuff and he'll speak honestly because that's the way he is. He's a very authentic individual, and he kind of refuses to play the role of the CEO that other CEOs are so determined to play. That's not always a good thing, right? You got to be careful. You don't want to buy into a business just because the CEO swears or because he's a bit of a yahoo at the meeting. But when you see someone who's authentically themselves or different from the norm, it's just something to know. That's a piece of information. Okay, they've decided. So if you see a CEO with long hair, David Dicker, if you see a guy with long hair and a weird beard, that's weird, right?
David Dicker was on my list here of oddballs.
Yeah. He deserves to be on that list. He deserves to be near the top of that list. He goes into work. He goes into presentations, company meetings. He knows the way other CEOs look. It's an active decision to grow your hair out, to grow your beard out, not to wear a suit, to speak gruffly, to be yourself and not to be the person that the other party is expecting to meet. Now, as I said, there takes a bit of judgment and a bit of luck, perhaps, to determine when someone's crazy and when they're a genius. But it's a piece of information that's worth noting, that this is someone who's not following the mold.
It's a piece of information you can't screen for. You can't sit on your filter process and put and just tick a box for oddball.
Not until that ETF comes out, anyway.
We'll have to get our the ETF providers onto that one. Any favorite oddball fund managers for you? Are we going to? Let's not out anyone.
John Hempton has come to our office a few times, and we used to have an office in Bondi, and Hempton's fund is run out of Bondi. So there's a few occasions where he came to the office and spoke to the team. He's done a couple of podcasts with us. He's an extraordinary individual, an absolute oddball, but he's got to be one of the smartest investors I've ever seen.
And he's on full oddball display on Twitter and.
I'm not on Twitter, so yeah. I can only guess at what he's going on about at Twitter. But in person, he is a force of nature. An intellect so fierce, but also just completely unrestrained, unapologetically himself. It's frustrating. I remember doing a podcast with him, and it was basically John Hempton speaking while the other person was sitting there quietly. But there is a genius in someone like that as well, and I'm quite a fan of it. I quite like it. I would say Kurt Nielsen is also, geez, he's an odd character, but also I think a genius.
I have heard a fantastic interview, a podcast on the Jolly Swagman with John Hempton. So
I know the one you're talking about. It's great, isn't it? Yeah.
If you've not listened to that, look it up. Now, Gaurav, I actually thought of you, believe it or not, when I was on holidays. And I
don't know where this is going, Mitch.
it was at an Airbnb in the Mornington Peninsula, and on the bedside table, there was a copy of Freakonomics.
Oh, yes.
And I'd never read it before, but I'd heard you speak glowingly of it when you last spoke with Owen. So I picked it up and I started getting into it. And I must say, I can see why you really, really enjoyed it. It is a fantastic book. So I want to come back to Freakonomics and to the quote of show me the incentive and I'll show you the outcome. So let's talk a bit about management plan incentives. I want to get your take on what makes a good short-term incentive plan or what makes a good long-term incentive plan. I know this will probably be business and industry specific, but is there any examples that come to your mind that for investors to look out for?
Yeah, it's actually funny you should mention that. We've been grappling with quite a high-profile case of awful incentives inside the business, and that's Karoon Energy, which is a stock that I own it personally. We own it in the fund. I've owned it for years, and it's difficult because I've actually made good money out of Karoon, and sometimes when you do very well out of a stock, you tend to be less critical of it. You tend to be less skeptical about the things that come out of it. And it was actually another investor. And, again, I would say also another oddball. I think he knows who he is. Another oddball who I was speaking to. And he pointed out that there are some awful incentives going on in Karoon. And sure enough, management was heavily incentivized. And the incentive payment made was to just make an acquisition. That was the KPI.
That was the incentive.
Yep. Full stop.
Something.
Full stop. Not buy something that increases earnings, increases EPS. Just buy something. And sure enough, they bought something, and that something they bought a field called Houdat in the Gulf of Mexico, and it hasn't performed all that well. So far, I think it's early days. I don't want to pour judgment on that particular acquisition, but I think the process here is what's interesting. They were heavily incentivized to do something, to buy something, with no other restraint on them, and I think that's a terrible incentive. And usually, terrible incentives lead to terrible outcomes. Now, there's now an activist campaign launched by this very same fund manager. I've just added him, and I think we've written about that and our thoughts on it, and I think there's a very good case to be made that there's been some poor incentives and some poor management behavior out of Karoon. And it's interesting because I probably would not have come to that without a discussion with an outsider, because we've made great money out of this business, right? And it's sometimes difficult to be critical and step back after you've done well in a company. So it's there's a great example of a poor incentive. Incentives are important, but I think also, finding, I'd rather have, I'd rather try and find an oddball. I mean, incentives are really important. An oddball sometimes doesn't always, follow the incentive. Someone like an Ellison, he just owns a lot of stock, and that is probably the best incentive there is, just someone who owns a lot of stock. I'm less impressed by fancy LTI and STI, short-term, long-term incentive plans. I don't like them as much. I just want to see my managers own stock with their own money, not be granted or vested equity. I want them to stump their own money down and buy equity in the business. That's what gets that's the ultimate incentive. That shows me that you're aligned with shareholders. It also shows a conviction and a belief in the business that you're running. One of the worst signs is when the board of directors doesn't own any equity. For me, that's almost I mean, that's a big red flag, and there has to be something really special about a company for me to then go off and buy it if that's the case.
How can you tell the difference between a token shareholding and meaningful?
Yeah. You're right. That's a fascinating question.
Someone comes on the board, they buy 50 grand worth of the company.
Yeah.
Is that meaningful to them? Is that a token gesture? You just don't know. Yeah,
you don't know. That's right. You want to be really careful about that because I'm not the first one to say, skin in the game. They've got to have equity. That's a very common refrain now.
It's become almost a
mainstream, isn't it?
Yeah.
Yes, and management is well aware of this. So sometimes what happens when something goes wrong in a stock, the board gets together and they decide, right, we better start buying some stock. And the worst thing is when you see the board or management buy a couple of $1,000s worth of equity after something has gone wrong. That to me is almost an automatic sell because you just know.
Because that's a token gesture.
That is a token.
Guys,
exactly.
Let's pull out our spare change.
And the action there, I mean, what they're trying to do is get the share price up. They're not trying to solve a business problem. They're trying to get the share price up.
Do you think they're trying to game those people who pay really close attention to insider buying?
Absolutely. That's the intent of it. Yeah. So be very, very careful about that. There is a line somewhere where meaningless becomes meaningful. And I don't have an answer for you where that is, but it's often you'll know when you see it. I think it's one of those things where you can recognize it, but you can't articulate it.
Perhaps going back through that person's past behavior as well.
And also their wealth. I mean, if they're comparing their equity to their salary is often a good place to start. So if they're getting paid $300,000 and they're putting down $5,000 in equity, that's probably tokenistic. But they're measuring those two and comparing them is often useful.
I have heard the saying, there are 1,001 reasons why people will sell shares. It could be a divorce. They could be buying a big boat. They could be doing who knows what. But there's only one reason they buy. Now we've just added in maybe 2 or 3 other reasons.
Might be 2 reasons. Yeah, that's right.
Just for those who don't know, how can you go and quickly check director trades, see the directors who are buying? How can you check the stakes that they have in these companies?
Mitch, you should be reading the annual report. So if you're reading the annual report, it's all disclosed in there. I'm constantly surprised how seldom people read the annual report. I think it's the first port of call when you're looking at a business. It ought to be. And if you go through there thoroughly, you can see not only who owns how much, but also when they've bought and how they've been allocated those shares. But there's also regular updates as well. So I think it's one of the appendixes that gets released by the ASX regularly. It shows you when a director has made a transaction and also the nature of that transaction. Is it money is it equity that they've paid money for, or is it options that are vested? It's important to make that distinction as well.
And then there's also the remuneration section of the annual reports where you can see these long-term and short-term incentive plans.
That's a good point, actually. Yeah, it's probably not. It's good to see how much they're getting paid, but it's also really important to go through and check what the LTI and STIs are. That can give you an insight into what the incentives are, but also it can sometimes tell you what the business itself is gunning for. And a recent example might be Lovisa, which has now changed quite surprisingly its CEO. And the first thing I did was go through and see what the incentive package was for the new CEO, and the EPS growth that he gets incentivized on is probably a little bit higher than I think what I was expecting and what the market was expecting, and it tells you something about what the company is aiming for. And to get that EPS growth,
that's earnings per share.
Yeah, but it's actually EBIT. Sorry, it's EBIT growth that their target is, not EPS. My mistake. But to get that EBIT growth, there are only a couple of levers they can pull. So it also then you can back solve and figure out, there's a strategy that they're telling you in words, but there's also a strategy that they're pursuing in their incentives, and you can check and make sure that those two things match up. I'm happy to say it does match up in Lovisa's case, but it doesn't always. Karoon, perfect example. There was a strategy they said in words, and what was in their incentives was quite different.
Can you just walk back through Lovisa for those people who don't know what the business and the investment case is? Because the CEO who has just left, and we're dating this, we're talking on the 5th of June. I just saw the article on The Intelligent Investor about the CEO stepping down. He was part of the investment case because he had a wonderful background in stores. I'm probably going to get this wrong, but Zara, I believe,
that's right.
Of rolling those stores out around the world. And that was a big tick for Lovisa shareholders that this person has experience in global expansion, because that is what their future growth is coming from. So can you walk us through, for those who don't know what Lovisa is, the investment case and the current and what's now taken place?
Yeah, so I've been a big fan of Lovisa for many years. Intelligent Investor has written glowingly about the business for many years. It's been a fantastic success story in its own right, and for us as investors. And it's just a retailer of cheap costume jewelry. And that may not sound very exciting, Mitch, but the financials are probably the best retail financials I've ever seen in any business. And that's because they combine extremely high margins, 80% gross margins, with extremely high asset turnover. They'll turn over inventory sort of 7 to 11 times a year. And once you combine high turnover with high margins, you end up with super high returns on capital. And that's the case here. Now, they're rolling out stores in what is probably the largest and most successful Australian rollout we've seen in living memory. And they're doing it successfully. And I think now the market has recognized that success. It's an expensive stock. But if you run through how large this business could be, there's potentially a lot of upside on the table here if they execute correctly. And that's where the CEO is particularly important. The former CEO, Victor Herrera, was handpicked by the board and its majority shareholder, Brett Blundy. He spent 12 years rolling out Zara stores across Asia, and a lot of that time rolling them out in China. He's a speaker of Mandarin, spent years living in China itself, and is known to be hands-on, detail-orientated. We've met him at the AGM and spent some time with him, and very, very impressed with Victor Herrera, and I was very happy to be invested alongside him. But he was granted a huge options package, and so it was costing. Last year, he was the second highest paid CEO in the country.
Came under scrutiny in the Financial Review a few times.
Well, it did, and the pay was extraordinary, but it was always the deal was. And Brett Blundy outlined this in previous AGMs. The deal was to get Victor incentivized. So upfront payments will be huge, get him as an equity holder in the business, and then have him working under sort of normal financial conditions and normalized pay. And I think what happened was that there's just been a dispute about the pay. So I'm guessing here, but my guess is that Herrera probably asked for some more money. And Brett Blundy, who owns 40% of Lovisa, probably said no. And so they departed ways. Victor will stay for 12 months, and then they brought in the bloke who was rolling out Smeagol stores for 10 years. And so I think that's pretty good pedigree. I hear that he speaks Mandarin as well. Look, as an investor in Lovisa myself, it's not a good sign. It's worrying. We had expected Victor Herrera to stay for many, many years to help roll out these stores. He's an outstanding retail CEO, and particularly his knowledge of the China market was really important. I mean, he brought along a lot of people in key roles, not just in China, but in other areas as well. So we have to wait and see whether those people stay or whether they leave in a year's time. But the new CEO also has spent time living in Asia, as I said, speaks Mandarin, has a 10-year pedigree of rolling out a really high-quality retail operation as well. So, look, it's not a positive, but I think the market's reaction has been quite extreme because the fundamental investment case is still the same here. This is an outstanding retailer with phenomenal economics, that's rolling out stores aggressively in those, and the store rollout's working. So I'm quite happy to hold Lovisa here, and I'm not panicked out of the position just yet.
Fantastic. Gaurav, thank you very much for your time today. And I, for one, cannot wait for I'm going to roll them up into one, the oddballs and F-bombs ETF.
I love it. I think we got to do this, Mitch. This sounds good.
I'll make
it's
some
the only investment you'll ever need.
That's it. I'll make. I don't know if it's going to be core or satellite, Gaurav, but I'll make a few calls. We'll get it happening.
I love it. We got to get a sexy acronym. All ETFs have fantastic little acronyms.
We'll work on that. If you've got a good acronym for the F-bombs and oddballs ETF, please pop it in the comments if you're watching this on YouTube. I really look forward to reading those. Gaurav, lovely to speak to you again, and thanks for your time, mate.
Good to see you again, Mitch. Thanks.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.